Hi guys, welcome back. Vici is one of my favorite REITs and the only REIT that I own in my portfolio. With their properties that include many unique entertainment venues, including half of the Las Vegas Strip, they not only pay a dividend of 5.3%, but could also grow this dividend much quicker than most REITs in the last few years. Right now, they get a strong scoring of 4.7 out of 5 from Seeking Alpha's quant system, which makes them a strong buy. And the company also reported decent numbers in the last earnings call and have raised the guidance for 2025. But the general tourism industry in the US took a big hit in the last month, which could spell trouble for the company if this continues. In this video, I will have a look at Vici's current financials, including the latest numbers, and the current market trends and what that could mean for the company. I will not go over the detailed business of Vici though, because I already did this in my last video about them. So, if you don't know the company at all, I would recommend checking out this video first. The link to it is in the description below. My name is Florian. Thank you for joining me today. Over the last year, Vici had a very similar performance as the S&P in terms of total returns. As of this recording, the S&P has a slight lead on Vici with 14% versus Vici's 12% total returns. And when we look at the performance since Vici's IPO in February 2018, the picture looks basically the same. Here, both companies also had a very similar performance, but the S&P could beat Vici's performance slightly. What I find interesting though is that the company could produce these returns with a lot less volatility than the overall market. Especially in 2022, where the overall market had a bad time and did fall overall. Vici could still hold up very nicely. We can also see this in the low beta of the stock that has a value of 0.43. This means that Vici's volatility is just 43% compared to the market. That is almost 60% less volatility while still producing very similar returns. Of course, one of the reasons for this is that Vici produces these returns with paying their dividends. And dividend payments are usually much more stable compared to price returns. So the same is actually true for many other REITs like Realty Income, for example, that has a beta of only 0.28. But then the performance of Realty Income was also much worse than Vici's, and their total returns from the last 5 years are well below Vici's. So the company has been kind of a stability anchor in my portfolio. And while they haven't outperformed the market, I am still pretty happy with their current performance. The company has also just reported their last earnings numbers, which weren't bad at all and have also increased their guidance. But before we come to the good news, let's have a look at the bad news first. Because there are some worrying trends that could affect the business of Vici. Because the hostile foreign policy of the Orange Man has affected the tourism industry in the US significantly already. Travel from some European countries like Ireland, Norway and also Germany to the US have already dropped by more than 20% compared to the last year, and the bookings from Canada also declined significantly. This has reached a point now where the US Travel Association has already raised concern about troubling trends and have called into question how welcoming America appears to visitors right now. Paul English, the co-founder of the travel website Kayak, even said that this might represent reputation damage that could take generations to repair. I honestly wouldn't go that far, and I don't think that the reputation damage is that big. But speaking from my own experience, I can indeed see that many people from Germany would not want to travel to the US right now. I myself was in the US almost every year for the last 10 years, either on business trip or for vacation. But right now, I am also avoiding all of the trips. For Las Vegas, where most of Vici's assets are located, this has resulted in a visitor drop of 7.8% in March compared to the last year. And in February, the drop was with 11.9% even in the double digits. So the thing is, Vici doesn't earn its money with the visitors directly, but with the rent of the real estate. So there is no immediate impact on them. But I still think it's a risk that if this continues for the next 4 years of Trump's presidency, it might get to a point where it will affect them. After all, foreign travelers are responsible for 20% of the US tourist income. But for the time being at least, Vici is still performing quite well. In their last quarter, their revenue increased by 3.4% compared to the year before, and their net income grew even more by almost 8%. For REITs, I like to look at the AFFO, the adjusted funds from operation, which reflects the business of REITs much better. And this increased by 5.6% on a year-over-year basis, and on a per share basis by still 4.3%. This is a bit lower than the average of the last 5 years, but still well above the sector median. And with all of their properties being rented out under triple net leases, their operators need to take care of most of the costs, which also means that they also take most of the risk. They also have a very long weighted average lease term that, including all renewal options, is over 40 years long. A good portion of their rent is also protected against inflation. Right now, 42% of their rent is subject to a yearly CPI-linked escalation, which means that this rent is automatically increased with the CPI. And Vici is also increasing the share of this. By 2035, even 90% of their rent will be protected this way. To me, this shows again that they put a large focus on a stable and steady income and are doing everything to protect their income against all eventualities. It also helps that they have a great balance sheet that is rated as investment grade from all 3 major credit rating agencies. They have also already paid back all debt that was due for this year, and a large portion of their still outstanding debt, including 3 billion in revolving credits, will only need to be paid in 2032. So in addition to the AFFO growth, the company could also increase their revenue, EPS, and free cash flow very nicely. But as usual for REITs, they have also issued new shares to finance some of their projects, which has increased their shares outstanding every year by a bit. This is a standard handling for REITs and not too worrying as long as they don't go overboard with this. All in all, this has left their revenue growth for the last 5 years at an annual 32.9%, their free cash flow growth at 29.9%, their EPS at 25%, and their AFFO at 8.8%. They also have a good balance sheet with 5 times debt to EBITDA ratio, and what is more important for a REIT, the investment grade rating from all 3 major rating agencies. They did issue new shares each year though, which has brought the average annual share dilution in the last 5 years to 18.5% annually. This is pretty high, but a big part of it came from the financing of the acquisitions of the Venetian and the MGM Growth properties, which was one of the largest deals for REITs ever in 2021. Since then, it has slowed down a bit again. The dividend yield is at 5.5% currently, and they could grow this dividend by 7.7% CAGR in the last 5 years. Their cash flow payout ratio sits at 74% right now. Valuation-wise, it makes no sense for REITs to look at the regular metrics like PE or PEG ratio. Instead, I like to look at the price to FFO and price to AFFO ratios, and also the price to book value in this case. And on a forward-looking base, Vici sits at 12.6 price to FFO and 13.7 price to AFFO. Their price to book value is at 1.27. These are all just a little bit below the sector medians. In addition to these multiples, I also like to see where the dividend yield of these REITs sits compared to their yield from the last couple of years. And in the case of Vici, this is currently roughly at the average level of the last 5 years. So the company doesn't seem to be too expensive right now. Compared to the sector medians, they seem to be rather on the cheap side, especially when we also take their larger than usual AFFO growth and dividend growth into account. And most analysts also seem to think that. The 23 analysts that give a 1-year price target for Vici see an average upside of 12.5%. Their EPS should grow with 4.3% per year and their revenue with 3.8% until 2027. But again, for a REIT, I rather like to look at the FFO. And the expectation for the growth here is a bit mixed. While it should stay basically flat for this year, for next year, analysts expect a growth of 5.5%. But after that, they see a risk that it might even shrink a bit. But this only reflects the company's current portfolio without taking any new projects or acquisitions into account. But REITs mostly grow with these acquisitions. One example for such a project is the One Beverly Hills development project, where Vici just announced an investment of $300 million. And this is just the latest investment in the long pipeline of growth investments with many different operators in different segments of this experiential real estate. So I think that this growth estimation is rather conservative and that the real FFO growth will be a bit higher. Before I sum this up and come to my conclusion, let's also directly compare them to some of their peers. And if you find this video helpful, please hit the like button and subscribe to the channel to not miss my next one. This really makes my day. And as a small thank you, I promise to read all of your comments and to reply to as many as possible. Thank you very much. For the peer comparison today, I choose EPR Properties and GLPI from the experiential sector and Reality Income and VP Carry to also see how they compared to more diversified REITs. Total return-wise, all three of our more specialized REITs could outperform O or VP Carry in the last 5 years. Vici even had the best performance overall, but only by a little bit. But Vici had the lowest dividend yield of the group, with GLPI and EPR taking the ground with a yield of 6.5%. But Vici could grow their dividend by far the quickest in the last 5 years. Usually, I also like to compare the valuation, growth and profitability metrics here. But unfortunately, these metrics that Seeking Alpha shows are not really a good measure for REITs. So let's skip them today. So overall, I still think that Vici has a place in my portfolio. I do like their long lease terms that are around 4 times as long as the terms for other REITs, and their occupancy rate is 100%, which is also great. I am also a big fan of triple net leases in general because it keeps a large portion of the costs on the operator side, which helps to avoid surprises. The CPI-linked rent also helps to further secure the income. So the name of the game here is stability, which is exactly what I want to have from a REIT. With this stability, they could also grow the dividends quicker than most other REITs, which makes them a perfect match for my dividend growth portfolio. And even though I agree that there is a certain risk with the slowdown of the tourist sector in the US, I don't think it's as big of an issue as some make it out to be. And Vici, with their mostly unique properties, are also still in a very decent position here. The share dilution in the last 5 years was quite a bit higher than what I usually like to see though, so I'll definitely keep an eye on this. But that is just my opinion, and because I'm already invested in Vici, I am definitely a bit biased here. So what do you think? I would be really interested to hear your thoughts down in the comments below. And if the dividend growth of Vici is not enough for you, I have a video right here where I go over 3 unknown companies that could all grow the dividends in the double digits for the last 5 years. One of them could even grow the dividend by 35% per year. And this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.